I'm Jason Stipp from Morningstar. After solid performance in the markets for most of 2012 so far, what opportunities are left for investors? Here to offer his take is Pat Dorsey, president of Sanibel Captiva Investment Advisors. Thanks for joining me, Pat.
Anytime, Jason.
You have 4 names for us today, some interesting stories here. The first one is in the tech industry, Intel. I feel like the conventional wisdom on this company is that they're behind the trend on mobile, they're in a secular decline, there's also some cyclical issues going on, but you say it's a buy right now.
Yeah, I mean, certainly they have not had the success in mobile one would have hoped, right? You know, these are the lower power chips and designs from ARM Holdings really have stolen the lion's share of that market. And they've been just behind the curve in getting kind of a low power mobile chip out there. But what you need to remember is that, of course, all these mobile devices we use, they use processing power that's based somewhere else, in a giant data center somewhere. And Intel has a pretty good chunk of the server market. So granted, it's not good that they're behind the mobile curve, but their data center business is about 25% of operating profits. That's growing at a much, much faster clip, at a mid-teens level, maybe low teens, relative to the PC business, which is probably more of a 5% grower longer term. Because PCs are getting replaced by tablets and is really a pretty moribund market in developed markets. PCs are still growing at a decent clip in emerging markets. So, and the company, of course, has a very good record of capital allocation. They recently borrowed about $6 billion at 2.5%, when their stock is yielding 4.5%, which is a good decision for a CFO in my book. And so you've got a 4.5% yield that probably can grow at 7 to 8%, and really one of the widest moats in technology. So from our perspective, we think that's a pretty good equity income holding.
Pick number 2 is in the defense industry, given the fiscal cliff and all the worries about cutbacks. Why would you go anywhere near the defense industry?
Yeah,
right now?
Why would you, man? Except that it's 9 times earnings, and the guy owned Gulfstream. So this is General Dynamics. You know, one of the kind of the big defense contractors. They own a business called Gulfstream, which makes the eponymous jets. That's about 30% of operating profits. This is a pretty cyclical business, and we've had a pretty good aerospace cycle so far. But their backlog is still pretty solid, and about 70% of their backlog is from non-U.S. customers. They really haven't seen U.S. corporations step back up to the plate. A lot of interest from Asia countries and corporations. A good chunk of their business is also what's called wheeled combat, so things like the Striker, and of course usage of that will ramp down as soldiers come home from Afghanistan and Pakistan. But I think at 9 times earnings, that's pretty well priced in. And the key thing here really is they have much less exposure than Lockheed, for example, to any single weapons platform. They get about 11% of operating profits from nuclear submarines. However, the Virginia-class submarines they've been buying have been reauthorized, delivering about 2 of them per year. And that weapons platform really doesn't get the political challenges that, say, the F-35 does. You've got about a 3% yield right now, payout ratio of about 30–35%. So room to move that up. Huge commitment to the dividend over time. It's grown about 13%. So I think your total returns and probably some good equity returns are going to be pretty solid on General Dynamics. You know, I like buying things when everybody thinks they're dead.
Let's swing over to healthcare. Another company that's been under some pressure is Express Scripts. Healthcare obviously had been in the headlines a lot because of regulations and Obamacare and the election coming up. What are you seeing in Express Scripts? What are the concerns? What are the markets worried about? And what opportunities do you see there?
Yeah, so the core thesis on Express Scripts is simply, you know, they purchased Medco earlier this year, giving them just a massive market share in the pharmacy benefit market. And they're one of the few companies, PBMs in general, that basically make more money as the system saves money. Because PBMs have a higher margin on generics than they do on branded drugs. You have a lot of generic branded drugs like Lipitor coming off patent. You know, that'll be a nice tailwind for the next few years. But the key thing is that they're sort of insulated from a lot of the political rhetoric that goes on because they're part of the solution to bending the cost curve, not part of the problem. Shares got a bit whacked in November on concerns about sort of slowing enrollment growth in 2013. At 13 times earnings for a business with a very high return on capital and some phenomenal secular growth prospects, I think those concerns are pretty well baked in.
Your last idea is in financials, an area that's done pretty well.
Yeah, absolutely.
What's the story with Wells Fargo? Why are you looking at it right now? Is that valuation isn't a screaming buy, right?
Well, it's pretty good. I mean, it's about 1.2 times book right now, which I mean for a company, with the quality of Wells Fargo running about a 12–13% return on equity is not a bad price. But really the story here is dividend growth. As you and I have talked about in the past, I think investors undervalue dividend growth and overvalue current yield. And at a 2.25% current yield, you kind of think Wells Fargo is not very exciting. However, Right now, their payout ratio is kind of capped at about 30% by the feds. Given Wells Fargo's strength and sort of the strengthening economy and the strengthening balance sheets of all of our financial system, I think the odds that that cap gets lifted at some point in the next couple of years are pretty good. And Wells Fargo's management has been very, very straight with people about saying, it's your money. We are going to hike that payout ratio back to the 50–60% range. And once they do that, on current prices, you're looking at a 5 to 6% yield, which I think is extremely attractive and probably will surprise investors when that finally does happen.
After a solid year in the market, it's good to know that there are still some good opportunities for investors and solid franchises to boot. Thanks for joining us today with those ideas.
Thanks, Jason.
From Morningstar, I'm Jason Stipp. Thanks for watching.